Pleasant good morning to all of you. I am Priyadashini here to welcome you all for today's Corporate Connect. Today, we will have a very interesting session on insights into the business model of fintech companies. Fintech is not a new industry, it is just one that has evolved very quickly. Technology has, to some degree, always been part of the financial world, whether it is the introduction of credit cards in the 1950s or ATMs, electronic trading floors, personal finance apps, and high frequency trading in the decades that followed. To know more about this, we have Mr. Kevin C Mathew, Senior Business Consultant, with us today. We welcome you, sir. I welcome our Director, Dr. AGV Narayanan, for today's Corporate Connect. Also, I welcome all the faculty members, students, and all the participants for today's Corporate Connect. Once again, I welcome you all. Have a nice day. Now, I invite the section of First MBA to introduce the speaker. Thank you.
Good morning, all. It's my privilege to introduce today's speaker, Mr. Kevin C Mathew, Senior Business Consultant at Ernst Young. He completed his bachelor's degree in technology from SMS School of Engineering and Technology in 2011. He went on to pursue his MBA in Bharathidasan Institute of Management. He has worked as a sales engineer in Gilbarco, Veeder Private Limited and Voltas Limited in the domains of project cost estimation, feasibility, cost management, contract negotiation, and finalization. He went on to work at Ernst Young as a senior business consultant with key industry focus in FMCG, power, real estate, and automobile sector. He has a vast number of certifications such as cost and economics in pricing strategy from Boston Consulting Group, accounting analytics and quantitative modeling from Wharton University, and Python for finance, Azure, SAP, and robotic process automation. His awards and recognition include EY Client Champion, 26th rank in the Capstone Global Strategy, first place in operations simulation from IIT Calicut, second place in economics case study from IIT Amritsar. Now, I would like to hand over the session to Mr. Kevin C Mathew. Over to you, sir.
Yeah, thank you, everyone. So I'll just present my screen and we'll get it. We'll start the session. So the fintech space, is my screen visible?
Yeah, visible, so you can go on slideshow mode. Sir. Perfect.
So the fintech space is, I've mentioned the topic as payment processing companies because a large section of the fintech is directed towards payment processing to kind of leverage on the networks. It's the person who introduced kind of dwelt on it in terms of fintech is not a new concept. It's a pretty old concept. It's an evolving concept where, you know, your credit card and your Visa networks, they kind of started the entire fintech revolution, you might add. So it's kind of interesting how the entire credit card business has evolved. Because if you really look at it, one of the first operators was American Express, Amex. So they were pretty much dealing with a traveler's check, where it was pretty much based on your networking was pretty much based on traveler's check as a product. Then the credit card notion was introduced, the concept was introduced, and Amex also got into it, and that's how Visa and all the others have started to play into it. So I'll just talk about what kind of business is the payment processing business, and also how most companies are trying to leverage that business and trying to get into other operations of financial services. So just a quick introduction in terms of why exactly is this sudden push towards digital finance and digital banking and the entire fintech revolution. There's a huge hope and a lot of optimism in terms of fintech revolution in India. So one of the primary reasons is your smartphone revolution. So today we have close to 60 crore users of smartphone, and that percentage in terms of your total population is going to keep increasing because one is it is the cost of smartphones are going down, and your mobile payments, when you compare that to your credit cards, are significantly increasing, particularly during the last 3 to 4 years. That has significantly increased. Now, if you really look at the total number of debit card users, it is about, I think, close to 95 crores. The total number of debit cards that are active debit cards that are issued as per RBI. And the total number of credit cards, if you look at it, it is 6.8 crores. So that is pretty much, it says for every 100 debit cards, there are only 7 credit cards. Now I'll come up with the issue of, there's always a social context to it, where people say that, the business of credit cards, giving credit is actually a very bad business, because one, your interest rate is pretty high. It leverages on people to consume more. It expects people to consume more. And but if you really look at it, the role of credit in society is pretty much, if you really look into it on a fundamental basis, it is so that you try to buy or consume things that that would take probably 10 years or 15 years or 2-3 years of your savings for you to get those things. Suppose I need to buy an automobile. So if I am supposed to buy it purely based on my savings, then I would have to probably wait, say, X amount of years into the future. So the credit space is pretty much aligned so that I buy it now and pay later at a cost. So these are pretty much your the point of sale deploy by various banks. So I'll just go through these 2 slides where Bharat QR, the deployment of Bharat QR and POS by different banks, and you could see that how private sector, especially HDFC, has been dominant in terms of the adoption. Now, this slide is pretty much, it explains the entire business of the card network. So the buyer on the left-hand side, say he purchases something for 100 rupees. Now, so he purchases it using the credit card. Now, there's going to be a bank that is going to issue the credit card. It is not Visa that issues the credit card. Say HDFC Bank is the bank that issues the credit card to that particular buyer. Now, the entire role of this is that, suppose you go to the merchant and the merchant has a different bank. Say the merchant uses State Bank of India. So the entire role of the card network is to link that bank, to link the HDFC Bank to the ICICI Bank. So there's a small transaction fee involved. So if you look at it, by and large, you would say, as a ballpark figure, for every $100, a bulk of it is going to be, so for every $100 of transaction, the merchant is going to get only $97.8 or $97.5. So $1.5 is the discount that he gives to the financial service providers as a discount. So it's called the interchange fee. So of that 1.7, a bulk goes to the acquirer company. And how the card network has the least amount in terms of the total interchange fee. So this rate is pretty much determined by the kind of risk that each of these 3 transaction holders, the kind of risk that each of these 3 financial service providers offer. So if you look at it, so the issuer bank has a significant risk in terms of, will the buyer default? The card network has the least amount of risk because his payments are pretty much guaranteed by the bank, and the merchant bank has even lesser risk because he gets the cash upfront. So this is how the entire system works. So you call the rate as a merchant discount rate. What is the total discount that the merchant has to make or sacrifice in terms of providing a service to the buyer, in terms of him availing a certain purchase at a grocery store or at a supermarket. So that 1.5 rupees, 2.5 rupees, that's the amount of discount that actually the merchant pays. But this is theoretical, but you could say that, he kind of prices that 1.5 or 2 rupees in the cost price of whatever we consume also. That margin somehow it gets distributed within the consumer also. There is significant regulation in this market. So if you look at it, so you would have that the merchant discount, you would have a certain cap limits in terms of the merchant discount rate mandated by RBI. There isn't any MDR in terms of for the credit cards, but it is there for the debit cards as a percentage of your transaction value. Now you might ask this question: why should a merchant accept this method? Because he's incurring, because he's selling a product to a consumer for 100 rupees, and why should he give a discount of 2.5 rupees or 2 rupees to these three financial service providers? It is because if suppose I as a merchant do not accept this methodology, I do not accept it, that there is a huge possibility that I lose customers, because a customer might prefer to use his credit card or his debit card and does not prefer to use his cash. And the second reason is that credit kind of accelerates the consumption. So if I am using a credit card, I might purchase more in a supermarket or a grocery store than if I were to use my own cash. So these two factors kind of play into it. Now I'll just briefly explain what is this all about. So there are different advantages for each and every industry. So some industries would, or the competitive advantage some industries leverage on is economies of scale, where if you reach a certain scale, you will be able to, you could reduce the overall cost of the costs involved and operating costs, and then thereby you'll be able to maintain a certain level of margin compared to your competitor. But in terms of this business, it is a network effect. So suppose, say, as a big time retailer, I don't accept Visa credit cards or Visa's debit or credit cards. Now what would happen is that leaves a whole host of customers out of that service level. So I wouldn't be able to process any of Visa's credit cards to a significant bunch of the customers. So that's how this works out. So it works out based on, as a user of the credit card, my credit card is being used or can be used at a whole different points of sales. And as a POS, there is a whole host of customers who are owners of Visa or Master or American Express credit cards. So that's how this entire thing works. So if it is a network effect, just like you could say Facebook is, because everyone uses Facebook, it compels the other person also to join in or use the particular platform. So overall, if you look at the fintech space, you could say that wallets, recharge, and there's a lot of cross-selling. So the wallets and recharge are pretty much B2C markets. So then there is the payment, the merchant discounts. So the cross-selling is a platform where, so once you establish a platform, so once you are, say, consider Paytm as an example. So you have a platform where your payments are getting processed, you were able to maintain a wallet, and you're able to make you can recharge your bills. So all these happen, and you have a platform where you have an active user whose share of mind you're able to capture. So that particular person is going to open the application, and so that you get his attention almost on a free of cost for any other products. So you can cross-sell a whole lot of products like your insurance, your investment options, and all those things. Buying digital gold, all of these things are in a way they are trying to leverage the existing platform. So this is the brief on Paytm's financial statements. So you kind of get an idea. Yeah. So you get an idea in terms of what exactly are the expenses and what kind of expenses are kind of constructing the entire space. So if you really look at the initial years of, say, a PayPal or even the credit card business, the initial years are it is banking on the number of users. So this industry's core economics is that it will evolve into a oligopoly or a duopoly. That's how it works. It is not say like a cement industry. So if you take a cement industry, it pretty much depends on your access to raw materials. So limestone pretty much is, you could say 80% of the limestone, which is a key raw material for cement, is available in the southern parts of India. So that's where most of your cement plants are going to get concentrated. So this industry has a different purpose. So even if you're a small time cement player, you have access to certain raw material and there's no competitor hereby. So you will have a prominent role in that particular market. So that's how that industry works. But in terms of any industry that leverages on networking effect, it will gradually evolve into 3 or 4 big time players who try to dominate that particular space, because it is based on purely the number of users of your product. So the more the number of users, the more you have the ability to convince the merchants or any other financial service providers to join in your platform, and you get a certain small percentage of the entire transaction volume. So it's more like you getting a royalty on each and every transaction that happens. A transaction, say I could buy a certain insurance product. So using this platform, so for every 100 rupee of insurance that I buy, maybe 1 rupee or 50 paise is what the commission that I'm going to give to these platforms. That's how this entire game works. So a huge number of money, if you look at it, is spent on your marketing and promotion. So the business promotion is, so that's where you look at your Google Pay or Paytm, you'll have all sorts of promotion activities where if you make a transaction for 500 rupees, you get a lot of discounts or other benefits. So it's a way to attract users and capture that market. So because they incur so much expense upfront, so the revenue, if you look at, the revenue is close to 3,000 crores. By and large for the last 4 years. And if you look at the overall the profit before tax, it's almost equal to the revenue, you could say, because for every 100 rupees of revenue that you incur expenses of close to 200, 217, 215 rupees, because you have to spend a lot in terms of acquiring users. Now, how you might never know how that is going to phase out, what is going to happen into the future. We'll come to that point. So the next is in terms of a look into the balance sheet. So if you look at it, because the equity portion has been, it ideally should be much lower, but much of the capital that is getting infused is by big time companies like the Alibaba and Financials, Berkshire Hathaway, SoftBank. These are big time companies that are infusing a lot of cash into this. And if you look at the overall balance sheet, a bulk of their assets are in, their investments are into acquiring different companies or different technologies, and financial assets like your mutual funds or your debentures. These are the primary assets that are involved in it. And if you look at their working capital, the payables and your net is pretty much, you have a lot of receivables or recoverables from the bank that is much excess to what are the payables that you're supposed to pay. So it is not really a very favorable net working capital expense that you look at it from that angle, because the banks have a much larger leverage in these scenarios. So just an overall look at the competition. So there's a metric called the take rate. So the take rate is for every 100 rupees of transaction that I go through as Paytm or PayPal or whoever the processors are, what is the amount that I'm able to recover? What is the amount that goes to me as revenue? So what is the total gross merchandise value So 100 rupees of I buy something for 100 rupees. Of that 100, how much rupees goes to me as my revenue, as my commission or discount or revenue stream? How much is it? So if you look at it, it has been significantly reducing over the years from 2017 to 2021, primarily because of the competition involved and because they have reduced the revenue to acquire users. Like I said, mentioned earlier, this business is all about who acquires users, and then they'll be able to increase the take rate. So if now today they have a take rate of 0.7 or 0.5%, once they get a significant share of users, then they'll be able to increase it. Because once you have, say, 60, 70 crore users that actively use your platform, you will have a better negotiation with the concerned retailers or your merchants. So a bulk of the payment transactions, if you look at it, Paytm has pretty much focused on the person to merchant category. That's where their primary focus is. And if you look at the users, the increase in user rate is 11%, which I think is much lower than what it should be, because for the amount of, as we saw in the earlier slides, the amount of promotional expenses that you incur, you're burning a lot of cash initially. And for that, the number of users as the number of people is I think is a much lower rate. And one of the reasons is because I think of the intense competition that Paytm faces. But in terms of the user transactions, so a single user could have multiple transactions. So that has increased significantly in terms of 41%. That's because the same base of users have repeatedly been using the platform. So that's a pretty good sign. So these are the comparison of the take rates of competitors. So if you really look at the active user base, so this is a comparison between Paytm, Visa, MasterCard, American Express, PayPal, and Ant Financials.
Kevin, if you don't mind, can you please explain take rate again, if you don't mind?
Yes.
Yeah.
So take rate is, if suppose I go to a particular supermarket and I buy a product for 100 rupees. The merchant or the supermarket, so 100 rupees is going to be removed from my account, but the merchant or the supermarket owner is going to receive only 98 rupees.
Right.
2 rupees is going to go to the 3 financial service providers. One is the bank of the supermarket owner. Second is my bank, my own bank. And third is the card network. Either Paytm, or it is going to be Visa, or it is going to be American Express, whoever it is, the concerned card issuer.
Yeah.
So take rate is, so this is for Paytm, and for Paytm's take rate, that is for every 100 rupees. So Paytm was able to capture 2.18 rupees in 2017 on an average. And in 2021, Paytm was able to capture 0.79 rupees for every 100 rupees.
Okay.
So that the take rate is pretty much important because it shows the kind of leverage you have in the entire transaction. So if you have a huge number of user base and if you are able to command a certain premium, I would say a classic case is American Express, who have a very high take rate compared to all its competitors. That's because American Express has a special cash in terms of people who use American Express cards have a certain the brand has a certain representation. Yeah. So it's able to, even if it is at a premium, it is able to, it is able to raise its take rate percentage. So it is able to probably around it is 4.5% for American Express.
Okay.
Able to deliver that. Yeah.
Okay. So for Paytm, it has been coming down. Am I right? From 2.18 to 0.79.
Yes.
So naturally, the bottom line will take a hit. Am I right?
Yes. So it is a conscious decision. Partly, one of the reason, there are 2 reasons. One of the reason is the competition. So you have big time competitors in terms of your PhonePe and Google Pay that are backed with huge amounts of money, as much as Paytm is backed. The second reason is they need to do this to increase their users.
Yeah.
It is about who captures the highest number of users as quickly as possible and who's able to sustain it. That person will have that ability to increase the take rate.
Right. Kevin, there's a noise from, is it from your side or is it from outside? Shiraman?
Sir, actually, I think
Could you hear the noise?
Yeah, it's a bird's noise, I believe, sir.
All right. Okay.
Oh.
From my side.
Yeah.
Okay. Right. Please, Kevin. Yeah.
So this is just a comparison in terms of the take rate of its competitors. By and large, if you look at it, American Express, as I said, has 4.22% in terms of take rate. But if you look at the number of active users, that's pretty low for American Express. So that's how they have designed their business model. They are into very niche market where the high-end consumer, that's their focus. But in terms of MasterCard, Visa, PayPal, and financial, they are into the broader markets where they're trying to gain much more market share of the common consumer. So if you really look at the fintech space, they use this technology. Most of the fintech players, including Paytm, use this technology to get into the lending business. Now, this is where it kind of gets even more, there's even more doubts involved, because so if you really look at the lending business, there are four factors that are primary to it. So lending is pretty much, if you look at it purely as a business, you could find a lot of similarities to a commodity business. So you look at money as just a commodity. So your raw material is your commodity. You sell it, you give it as a finished goods, and you expect the same good back at a certain, higher quantity. That's very simplistically, if you look at it. So if you look at the Indian scenario in the Indian banks, these four factors. So you take the first factor, the cost of capital. None of the fintech players will have a lower cost of capital compared to banks, because the sources of funding of banks are at a much lower percentages. If you look at, say, an HDFC bank, you have a terminology called the CASA, the current account savings account. So as a total deposit, percentage of the total deposit, HDFC has close to, I think 40% as the CASA rate. So that means, close to 40% of his deposits as a source of fund is coming from low interest rate or low cost of capital. So, but fintech players, for them, the source of fund is either going to be capital infusion, equity infusion from the parent company. Both of these have higher cost of capital. So, which is why, in terms of cost of capital, they will lose out to the banks. Now, the difference, you could say that you take a case like a Bajaj Finance. Obviously, this rule applies to a Bajaj Finance too. So that's where the second part comes. So if you look at a capital market, we'll have different types of seekers of lenders. So the asset class will have different variances of risk involved. So if you take all the blue chips companies, the top premier companies that are well managed, have very good financial strengths involved, say your Asian Paints or your Hindustan Unilever. So obviously, banks that are going to lend to those are going to be banks that have the capacity to lower the interest margin. By that I mean, if you say an HDFC bank, which has pretty much one of the lowest cost of capital, they would be able to deliver, a lower interest rate loans to all the premium companies, all the premium companies or consumers compared to all the other banks. So that's a space that is, pretty much taken by most of the well-established banks in India. So there's another space where, a company like Bajaj Finance has pretty much operated. That is where the second part, which is pretty much the most important part in terms of lending business, comes in. The risk. How do you assess the risk of lending, and how do you, factor in your interest rates, and how well do you manage your non-performing assets? So I'll come to that later on. The third is the trust. So what kind of a trust that the person has in terms of the financial integrity, the cyber security, all these factors, the transparency level. So all these kind of tilt towards the banks. The fourth is the factor where it kind of favors the fintech space. It is in terms of distribution. So earlier, banks used to rely a lot on physical distribution modes. Fintech space has been able to completely avoid that, and they're able to distribute it using all the online platforms available at their expense. So that's the benefit that they have. But I think that's a very temporary benefit. I think banks nowadays have the same distributional strength as a fintech can provide. So I'll just explain in terms of the Bajaj Finance and how that Bajaj Finance has used technology in terms of creating a space in this market. So if you look at the net NPA of Bajaj Finance during the early years of its inception, 2007, 8, and 9, it was very high in terms of 7% to roughly around 7%. Today, it has one of the lowest NPA rates. So the usage of tech. So how has Bajaj Finance carved a market for itself in this space? So it obviously cannot compete head on head with, say, an HDFC Bank or an ICICI Bank. It cannot do because of the cost of capital differences. Now, what it can do is it can leverage technology in identifying those asset classes where the asset classes that are underserved by the existing banks. Say, for an example, something like a self-employed person, say I'm an architect who has reasonable cash flows in his account, well-managed financial, but my CIBIL score might not reflect it because I'm self-employed. So Bajaj Finance would be able to, by the usage of its data analytics, it had done years back, way back in 2010, 11, and 12. By the usage of data analytics, it was able to identify them and give a better financial services to these particular customers. So back then, what would happen is that it went to a few of the big time retailers like Chroma, and it would set up a small stall within the Chroma retail store where they would process loans to the so-called customers within 5 minutes, which was unheard of at that time. Today, almost everyone is in a position to do that. So it is able to process loans is one thing at a quicker time, but the more important factor is it is able to process it. It is able to assess the risk accurately. So the credit risk assessment was far more accurate compared to anyone else. That's how Bajaj Finance was able to use technology to kind of carve a market for itself into this. So I'll tell you Bajaj Finance case itself in terms of what is the problem or what is the the entire danger lurking in this sector. So you will have assets, you will have certain assets like infrastructure related assets. It could be in terms of funding for construction, heavy equipments, heavy engineering equipments, or in terms of infrastructure project developments. So these are ideally, you might say that these, during the boom years, these assets might look pretty tempting. But what would happen is that the lending into this space during economic growth would crowd in a lot of players for lending, and that would reduce, that would intensify the cost and reduce the net interest margin. So by this, what would happen is that your interest margin goes down and the risk of your asset starts to appreciate because as is the case for infrastructure, it's a cyclical business. So it is the most prone in terms of your post-growth years. So that's where it is a sector that gets most affected during the years of recession. So because there is an immediate contraction of the cash flows. So Bajaj Finance as a company is one of those few lenders who was initially into the space, but they were able to identify it early on that this is a space that they need to avoid, and they've been, because it is not that the sector is bad, but the sector is too competitive, and it is not, the risk to reward ratio is not in favor of lending in that particular space. So that's how they've been very successful in terms of usage of technology to assess a risk properly and to lend in the most efficient way. So yeah, that is it from my side. I think I'll leave the floor open to questions.
Okay. Thank you, Kevin. It's a different insight altogether with the reference to all the fintech companies. Kevin, it is not only with the reference to fintech companies. Even if you look at the e-commerce of late, they seem to be burning their cash towards customer acquisition, and it keeps happening for years together. Am I right? It is not like, for the first couple of years, they'll be spending money on this, then subsequently they will start making profits with a healthy bottom line kind of. But I don't think it seems to be happening. So where are they heading towards? And in spite of this, they seem to be receiving all kinds of funds. Am I right? Whenever they are going for an IPO kind of, it is oversubscribed. How do they function? Where are they heading towards?
It is, I personally feel that the e-commerce space is not I don't think they are going to reach any level of profitability in the near future, because the market is very different compared to the US market. So I don't see that happening anytime soon. I've never seen Flipkart posting a profit in any of these years of the last.
That's right.
Since its inception. So the companies that invest in Flipkart or the companies that invest in the e-commerce space, if you really look at the overall percentage in terms of the total availability of cash that they have, it's a very small percentage for them. So they kind of take bets on these emerging markets. So for Amazon, I would say that from the overall business operations from US, it's a very small bet that they make on India. So they are ready to wait and burn cash and gain that market share. That's how they try to. So they are ready to wait for the next 10, 15 years also, waiting and trying to capture the market share.
Okay.
And same for Flipkart. For Flipkart, it is being backed by Walmart. So even for Walmart, if you really look at it, is kind of saturated in the US market. So they need to kind of somehow find a footing in some of the emerging markets like India or China, so that they can further grow in the future years. So it's a problem of enough cash, and they don't know what to do with the cash.
Yeah. Okay. Shiraman?
Yes, sir.
We can make it open to the students.
Yes, students and participants, you have the access. So you can raise your hand, unmute yourself, and you can ask your questions. So before some students come, I have a question, sir. Sir, now in the past, if we want to do some net banking, we used to log into the net banking and we used to do all sorts of transactions, and banks were comfortable doing all digital promotion in their net banking browsers. But now after Google Pay and Paytm has come, I don't think many people will actually log into the net banking. So how this is going to affect the digital marketing promotions of net banking or in that matter?
No, for banks are pretty interesting cases, because even if, say, the Paytm story wins out, banks will always get their cut of the share, because eventually it is going to be routed through banks. So banks are always, the idea of banks is always to be in the loop. So be in the system, whether it is the net banking system, or whether be it in the UPI system, or whether be it in terms of the P2P or P2M markets that Paytm and others have been involving. They just want to be there, that's it. So even just their presence will make sure that they get a certain percentage of this. They're not really concerned about who's adopting which. So even if, say, Bharat Pay, some subsidized government initiative is there in terms of the space, banks are willing to adopt it, because for banks it's just about having a presence in that particular segment. They're not concerned about what kind of model or what kind of operation is going to evolve or what kind of technology is getting involved. So that's how banks have been looking at this.
Okay. So will this lead in the future where net banking is going to become something like obsolete, or people will start only transacting through Google Pay and Paytms?
Yes. If you look at, say now banks are looking at ways in which you get pre-approved loans. So if you want to buy some consumer durables, you get pre-approved loans. And you get a QR code. All you have to do is take the QR code, go to the particular retailer and show the QR code. That's it. Even something like a health insurance is going to move towards that direction. Gone are those days where you need to fill up a lot of forms, and so everything is going to happen within a few clicks of a button. So that's how even something like a health insurance, where you need to be really careful in terms of how you price your premium, that is going to happen. Shift to this sector, this segment, where everything is in a matter of few minutes is accessible to you using your smartphone. So things are finalized in a few minutes.
Thank you, sir. Prabhu Shankar, sir, you can ask your questions. Professor Prabhu Shankar, you can ask a question.
Morning, Mr. Kevin. I'm Dr. Prabhu Shankar, Professor. So my question is based on a media report. And a media report says that Indian software as service firms, right? SaaS firms, Indian software as service firms could create more than 1 million jobs in 2030. If you ask me specifically, they says that firms can create more than 500 billion US dollars in market value by 2030. That is by using artificial intelligence, So do you think the fintech companies also playing a major role in creating more job market, especially for white collar jobs by using AI technology? Because most of the fintech companies, as you said, that using software as a service, right? It's a software and automation company. So your views on that?
I don't see a lot of jobs being created by fintech companies, because end of the day, because you're trying to say Bajaj Finance is an outlier, is one of the thousands of companies that has been able to successfully use technology. It's a pretty difficult space, because you need to find a market where the banks have kind of ignored, and then you need to, within that market, you need to find that space where you have certain individuals or certain customers who are not, who do not have excess risk. It is not too risky to lend to them. Because if you compete, the fintech companies cannot compete with banks on a head-on-head basis. They lose out in terms of because of higher cost of capital. So overall, I don't see that. But as software as a service, I think the Indian IT industry and the overall software industry of India, that could create a lot of jobs. That industry should definitely create a lot of jobs.
Like companies like Amazon Web Services, right?
Yeah.
Amazon Web Services, Freshworks. So these companies, I think they can get more jobs in the near future.
Definitely. These companies will drive a lot of jobs.
Okay. Thank you, Mr. Kevin.
Thank you, sir. Darshan, you can ask your question.
Good morning, sir. Myself, Darshan, first year MD, sir. Sir, my question is like now Paytm wallets, RuPay, UPI is accepted by almost all the vendors, sir. But one company is an exception, which is Netflix. It's a very big company, but they don't allow users to pay through UPI, RuPay, or wallet. So why do you think that companies avoiding this strategy when they can make more money and more customers through that? For such a big company, why do you think?
It's a very good question. So imagine you're a consumer, you're a user of, you want to be a user of Netflix, okay, and you want to subscribe to their monthly plan. You go log in. You try. There is no UPI. There's no option for this. There's no option for Google Pay or your Paytms. None of that. would you shift from Netflix to some other user just because of that?
Actually, they don't offer payment, so I have no choice. So I shift to another OTT platform.
But I don't think a lot of people will shift to another OTT platform because they're very specific. I want Netflix. I don't care even if I have to pay in cash also. That's the strength of that brand, the brand of Netflix. So if some person really likes some show on Netflix and really wants to subscribe to it, I don't think they would mind entering the credit card details or debit card details. They don't mind going all the way through that. And so those kind of companies they can say that I don't want any discounts from these guys just for that service. My consumer base is pretty strong. They will opt for the credit card option itself.
So why do they opt for credit cards? So what is the advantage or credit card over UPI?
Yeah. So there's the second advantage is the subscription can be automatically renewed. So in case of your Google Pay, you cannot automatically renew your subscriptions. So they don't want their user to constantly be reminded to pay again and again every month. So they want long time users. So once I subscribe to the Netflix, every month on month, so a payment should be made from my credit card to the Netflix account. That's how they want to operate them. Okay. But with companies like Netflix, which are very good company, very strong brands, will be able to do such a thing.
Yeah, in fact, it happened to me recently when I wanted to subscribe to LinkedIn Premium service. They asked for all the credit card details. They didn't accept any other mode of payment, Darshan. Okay, and of course, I had no other option but to give. Okay, they had a 1 month free trial, and the trial ended on 9th February. Then automatically they deducted the amount from the credit card. So that is what some of the players who are dominant they are doing. If they are dominant, they cannot afford to do it. Am I right, Kevin? Now for LinkedIn, I have no other option but to go for it. Okay, similarly, Netflix, we have no other option, no equal competitor in the marketplace.
Yeah, Mr. Balaji, please introduce yourself and you can ask the question.
Hello, Kevin.
Yes, sir.
Yeah.
Hi,
Balaji.
myself. Hi. Myself Balaji. Actually, first I introduce myself better to you. Actually, I am working in a city union bank, and I'm taking a role of fintech solutions and financial solutions in a technology part and payment solutions and ATM switch application handling. So my part is that how companies like you and FIS and other financial service providers are approaching the banks like two different type of banks like public sector bank and private sector bank for adopting a new technology. How it is tough to handle that public sector bank and private sector bank, because it is very much easy for that market leaders like HDFC and ICICI. They are ready to adapting for new technology, but old private sector banks, they are not ready to adapt. Public sector bank, they are not ready to adapt our new technologies. How you people are going to handle this kind of thing? And I have few more questions also with you, please.
Yeah. So basically, we don't handle any of these things. So for public sector banks, it depends on case to case. Say you take something like a State Bank of India. The YONO app of State Bank of India is one of the best apps. If you look at the mobile platforms, it is one of the best. You can almost compare it to HDFC, the application provided by HDFC. But there are, by and large, I've seen even public sector banks use technology. They are open to adapt to new technologies. The problem is, in terms of public sector banks, they have not really cracked that issue of how to assess credit and whom to give credit. So public sector banks, if you look at it, has as much the advantages as other banks in terms of they have huge number of deposits, low cost capital, but since its inception, almost all public sector banks, including State Bank of India, if you look at it, they are non-performing assets. have always been significantly much higher than the private sector banks. So that's because the private sector bank is much more focused and they have much more processes and methodologies in place to keep the non-performing assets in check. So they are very clear in terms of where to whom to lend and how much should my interest rate be. So that is, I would say, more of a bigger problem to public sector banks than the adoption of technology per se. Technology, I think, because you're not, as a bank, you're not going to adopt, design the technology from the scratch. You have a whole host of consultants and software service providers who can give you solutions. That is not the challenging part. The challenging part is in terms of how do you decide, how do you want to implement the technology, and what is it that, how do you assess your risk properly? So that's where public sector banks have failed, by a great deal.
Okay. One more thing is that Ministry of Information and Technology data tells that Indian technology, for example, Indian financial transactions, which is based on technology, is now we are beaten that what is the number of transactions which is initiated in China. So we have more number of transactions compared to China. So it seems that we are having more number of platform for technology based environment for newcomers. How what is the opening for newcomers like freshers or those who are looking for the technology based environment? What they are looking for, how they trained themselves for enter into this kind of financial technology solutions?
Okay, so can you clarify in terms of what do you mean by financial technology solutions? So by newcomer,
for example, financial technology solutions means they call something like UPI is there, and net banking is there, mobile banking is there, debit and credit card management is there, and switch management is there, payment solutions is there. I'm asking how they are developed themselves in this kind of financial technology solutions to train themselves for enter into this kind of environment.
See, there are two ways. One is trying to improve the entire processing. So basically, what are these financial service providers doing? They are transferring money from one end to the other, from the consumer to the bank, in as little time as possible. So the time factor is one, but that if you really look at it, the time is pretty much, I think it has capped its limit. Nowadays, the time it takes for transfer is almost instantaneous. The second is, how do you differentiate it in terms of, say, a single platform giving you a whole host of other services? So one service is payments. What is the other kind of service that is very useful to you, that helps you as a consumer, that makes you, okay, this particular platform is very useful for me and I'm going to use this repeatedly. I'm not going to go away from this platform. So how do you provide a certain differentiation in terms of this? As of now, I don't see much of a differentiation. Almost every platform pretty much is the same. There isn't too much of a difference. Of course, you have certain platforms like your HDFC or ICICI or Bajaj that have a certain, certain processes in place in terms of the banking operations, where you find much more comfort level. So I'll tell you a small case where for Kotak Mahindra, for one of my friends, there was a cyber attack, and there was some amount of transactions that were made without his knowledge from his credit card. So he had his credit card, but so some transactions happened without his knowledge, and he received the SMS. But Kotak Mahindra was able to identify it even before he raised the complaint itself. So Kotak Mahindra was able to identify it. That particular forensics team called him up and asked whether this transaction was made by him. He said no, and immediately they reversed the transaction. But so that's the kind of service, additional service. That's not typically, if you look at it, banks can say, you might have shared your credit card details to someone, we don't know, or that is your headache. We cannot do anything. But because banks have now evolved into this stage, so this particular consumer is never going to leave Kotak Mahindra in the near future. He has a particular trust in that particular bank. He's not going to switch to another public sector bank or another small time player. So that's the kind of additional service that you need to offer so that your customer sticks with you. And he purchases all these small services. Say, suppose tomorrow he wants to purchase insurance. He's going to purchase from Kotak. So Kotak will get a small commission for that insurance product. Kotak is not going to sell insurance directly. It is going to be some third party who's going to sell the insurance, but he's going to sell it through Kotak's platform. So that's how banks start making more and more money.
And one more thing is that in India now it is entirely dominating by RuPay products. Okay, UPA and the RuPay debit and AEPS and the BPS and these kind of things entirely dominating by RuPay. How Visa and Master are going to Visa, Master and Amex, they are going to survive in Indian market because clearly says that the entire market is purely dominated by RuPay. There is no charges for UPI based transaction or charges for debit based transaction compared to RuPay and Visa and Master. RuPay is that transaction charges. I'm saying that from issuer to acquirer side, that entire transaction. RuPay is very much low compared to Visa and Master. How they are going to survive in an Indian market?
So RuPay is pretty much backed by government. They have the government has a lot of interest in RuPay to succeed compared to Visa and Master. And the recent issue has been Visa and Master have raised this issue with the US government, and the US government is in talks with India in terms of having a fair practice in terms of the rate having a cap on the transaction rates and all those things. So that discussion is going on, but I don't think you can completely negate Visa and MasterCard or American Express because see there are a significant number of travel that is going to happen from India to so Visa, Master, and American Express, these are networks that have a global presence.
Yeah.
You cannot RuPay cannot completely dominate, and RuPay eventually has to start making money also.
Yes.
So at that time they'll have to increase their transaction rates. So I don't think Visa and Master will be significantly under pressure in terms of the RuPay story. Might it might also be a significant player in the Indian market. It might, but other than that, it will not dominate. Say in the sense that it will not, be issuing there won't be 90% of cards that are issued in India is not going to be from RuPay. I don't think so.
Yeah, that's not correct. But the thing is that last 2-3 months before Mastercard data integrity is questioned by Reserve Bank of India. After that, they are stopped issuing that Mastercard inside India. So after that, most of the banks like us also, we are a little bit getting little bit hesitate to issuing Mastercards to our customers. So we are alternatively moved to RuPay products. So this is entirely changed that market of Mastercard like that. That's what I must.
Yeah, because policy is being driven by public sector banks. Yes. If you look at the private sector banks, they are much more comfortable with Visa and Master. They have certain issues with RuPay in terms of how the payments are being made, how the recoverables are being made to the banks.
Okay.
So I don't think that story is going to last a long because Visa and MasterCard have raised this issue with the US government. So there will be talks between both the governments, and I think there will be some sort of a solution because right now the practices are kind of, the government is trying to push RuPay into, higher market share. So I think that eventually in the future will stop. That is my feeling.
Okay. One more thing is that, Kevin. One more thing is that, now in India, not only in India, in most of the countries now, crypto investment is very much familiar. For example, we are. It is very much questioned for capital of public nearby 1,000 crores.
Hello, Balaji sir, your audio is disturbed. Balaji sir, your audio is disturbed. I think you have some network issue. So let me. No, we are not able to hear you. Okay. No, sir, we are not able to hear. Okay. Yes, sir. Yeah, Kalimuthu, you can ask your question.
Okay. Good morning, sir. I am calling to final year student from TG Academy. Sir, my question is, what is the relationship between fintech and cryptocurrencies?
Fintech companies pretty much use that platform to sell cryptocurrencies. They see, basically you have a platform, say something like Paytm, you have a platform. You're incurring all the cost you have already incurred. So it is like you have some land. Okay, so you have used say 60% of that land, and the remaining 40% you might add some retail store or something of that sort. That's how this entire thing is going to work. So you have the particular platform, and you're trying to sell all sorts of financial products, whether it be cryptocurrency, digital gold, insurance, everything. Because you don't have to advertise and try to get. So suppose say there's another firm that purely focuses only on cryptocurrency. So that firm has to incur a lot of cost in acquiring customers. It has to advertise all those things. In these cases, since they have platform and since customers use that platform, they'll be able to sell cryptocurrencies without any incurring any additional cost of acquisition of customers. So these platforms by and large might use cryptocurrencies to sell. They might use the platform to sell cryptocurrencies. Yeah.
Thank you, sir.
Thank you. Thank you. Yeah. Rajat, you can ask your question.
Sir, thank you, sir. Greetings, sir. Myself, Rajat. I'm pursuing my first MBA at Fintech. So my question is, how does your work environment and culture in EIY varies from other organizations? Like, how is your work culture in EY, and is there any flexibility or something?
I don't know how the work culture is in other organizations, but by and large, I think it's a good work culture.
Okay.
For most companies today, the work culture is pretty, I would say, it is not what it was, years back. I think now companies are more or less very flexible in terms of providing you flexible timings, and the work culture is pretty good for most companies. It is even better, I would say, for MNC companies.
Okay, sir. So as we are stepping into the corporate world, should we be prepared with something like?
Just be prepared to learn and work. That's it. I don't think there is there's no shortcut, I would say. Yeah, it's just so the culture part and all those things. I don't. I think you'll naturally gradually evolve into it. You'll know eventually that either that culture kind of fits to your personality or it does not. There's no sort of you cannot. I don't think you can prepare for that particular. Suppose a culture of a company is more in terms of promoting very good talents and people who show a lot of promise. There could be other companies that purely are based on your metrics. What is your target? Have you met your target? That's it. We don't care what learning you've done, how much hours you spent. That's it. So that is going to be altogether different culture. So it is going to be much more short-term oriented and based on metrics and all this. So it will depend on your personality, and so you will eventually know which kind of.
Yeah. Okay, sir. Thank you, sir.
Yeah, Praizi, you can ask a question.
Good afternoon, sir. I am Praizi pursuing my final year MBA of engineering, sir. Sir, what are the opportunities available for MBA students in the fintech platform, sir?
So there are a lot of opportunities in terms of digital marketing and in terms of technology. These are two opportunities, but like I said, I don't see a lot of job creation in fintech space. I don't see that. Maybe banks might adopt the fintech space, and maybe banks might recruit on a few scale, but not to the scale that say an Amazon is going to hire, or a Bajaj Finance or someone else is going to hire. Not in that, or the IT companies are going to hire. Not in that scale. That is not going to happen. because they, right now they are struggling to make profits. So I don't think they'll, there's a huge amount of employee enrollment that is going to happen. Yeah.
Thank you, sir.
Sir, one first year student have sent me a WhatsApp. I think she lost her connection. She's asking, will fintech industry be the next big employer for HR students?
I think IT industry is going to be the next big employer of HR students, not necessarily fintech.
Okay.
IT always has been, I think, and it will be in the years to come also, because the adaptation of digital space has pretty much given a lot of tailwinds to the IT industry.
Okay. Yes. Participants, if you have any more questions, you can please unmute yourself and ask your questions. Mahalingam, I could see you were raising your hand. You can ask a question.
So good afternoon, sir.
Yeah, good afternoon.
My name is Mahalingam, first MBA. So my question is, how far blockchain technology helps in fintech space?
That technology, see, you take all these blockchain, all these technologies have been, I think, at least on a project level scale, been adopted by both the fintech and the banking industry. But it is not, there isn't any clear vision in terms of how the technology is going to match with my overall banking strategy. That part is still, I think, a few more years might be required to really get that connected. But most of them have invested in blockchain, and most of them are trying to figure out how to get into that space, how to leverage blockchain. But nothing concrete as of now, as far as my understanding goes.
Okay, sir. Thank you, sir.
Thank you.
So, participants, if you wish to ask more questions, you can please unmute yourself and ask.
Raman, if there are no more questions, probably
Yes.
we can wrap it up.
Yes, there are no more questions, sir.
Yeah.
We'll wrap it up, sir. Yeah. Okay. Yes. Thank you, sir. Indeed, it was a wonderful session, a lot of insights on fintech. And now let me call Mahalingam, our first year MBA student, to propose the vote of thanks.
Good afternoon, all. It's my privilege to propose the vote of thanks. On behalf of DJME, I thank our speaker, Mr. Kevin Mathew, for sparing his valuable time with us today. Thank you, sir. I would like to thank our director, Dr. AGV Narayan, for his continuous encouragement and support. Finally, I would like to thank our faculty, students of DJME, and all other participants for attending today's Corporate Connect. Thank you all, and have a great day.
Thank you, Kevin. Let's stay connected.
Thank you, sir. Yeah,
Okay,
sure.
have a nice weekend. Bye-bye.
You too. Have a nice weekend. Yeah.
Bye.